Well, for me, it's always about the P&Ls and the financials. And actually, one of the things that I'm always interested on is not the deliverables themselves, but how fast it takes to get when we're asking for management accounts, how quickly do we get them?
Hmm.
Um, and I know that because I know that when we're um, when we're selling a business, if we're not delivering the management accounts straight away, it's because we have to prepare them on behalf of the business.
Saul, welcome to the Direct at First show. I really appreciate you coming over to see this. We've been very keen to talk to you, so we thought we'd bring the show to your backyard, sort of thing.
Thank you very much for having me on. Yeah, it's exciting.
So, in 2019, you became the director of your Expert Eye. Now, from what I can see, you position yourself as somebody who focuses on sort of owner-led mergers and acquisitions and exits. But before this, you was like PwC, XBT audit. So that's some quite powerful jobs there.
Yeah.
What is the one instinct you still use today to kill a too good to be true deal before everybody wastes 30 days of their life on it?
um, I think actually the thing that really, if I think about, what's the transferable skill? It's something that someone said to me actually quite early on, or sort of in the middle of my time at PwC, and that was once you understand audit fundamentals, audit is audit, right? And it doesn't really matter if you are auditing financial statements or you're auditing, controls. It's about understanding the fundamental of audit. And if I think about what the fundamental of audit is, it's about getting to the bottom of what is the risk we're trying to ascertain, what's the risk that we really care about, and how can we give some comfort over that risk, and what can we do to sort of minimize that risk as much as possible. And that's the thing really that just it's carried me actually throughout the career. Not just when I was at PwC early on, but even now, we do exactly the same thing. We start every piece of due diligence, or when we first start looking at a business and valuation, we always start, what is the risk? Where is the risk in this business? What's the risk to the owner? What's the risk of this deal? And how can we mitigate that? How can we reduce it over a period of time? And that's really what keeps us going.
So, in plain English, right? If I was to come up to you and go, so what exactly do you do now?
um, well, I always say that I help business owners scale owner managed businesses through accounting and acquisitions. Um, but really, actually, it's a bit more than that because it's about helping successful business owners understand the acquisitions process. Because we all have to exit our business one day, you know,
Whether it's intentional or not.
yeah, exactly. It's going to happen. And it's about making people prepare, helping people prepare for that. Um, and actually, if you think about it, as you mentioned, like my career's been really sort of quite varied. And one of the big triggers for me to move into sort of the owner managed space was seeing my dad sell his business. So he had a small business that he was selling of his own. And I remember just thinking, like, everything about that was wrong. He had, poor expectations about what the valuation of the business was, what the deal was going to look like. He just had no preparation, not from his accountant or anyone else. There was no one who could guide him on that. And I thought it was a massive shame because I think that, and I see this all the time. There are countless people who they look at selling a business like they would selling a house, and actually the process is there are similarities, but the process is quite different.
Can we dig into that then? Like, in fact, before that, could you tell us a bit more about what happened with your dad and his business?
Yeah, so my dad he did fire extinguishers and sort of risk management for people. When they sort of you take out a shop, you have to do sort of a risk assessment and the insurance and all that sort of stuff. So he used to go round and they'd assess the risk in that place of a fire and then give you whatever you need to sort of mitigate that. So quite a sensible business. It did quite well. It had a recurring revenue off the back of it. It was, you know, I wouldn't say it was a multi-million-pound business, but it provided for us in our lives and our lifestyle, and so it was a good lifestyle business for him. Um, and he sort of had this number in his head of what he thought the business was worth. And, when he first started thinking about selling the business, I think that was like sort of 10 times his revenue. And then he sort of got a bit more realistic and he sort of started thinking about it in terms of profit. And it was sort of like 5 or 6 times his profit. And then he realized that, after a number of years, people kept promising him these numbers and no one was delivering. And I think he was starting to realize that actually he was being unrealistic about the number. And I think, to be honest with you, initially he didn't care about selling. It was, well, if you can give me this number, I'll take it today. And if not, I'm going to keep going.
Mhm.
And then my dad got ill. He got prostate cancer. He's fine now, but he had prostate cancer, and he was sort of forced into this position where, okay, you need to sell it. Like 6 months, you're going to have to be out of this business. I think he realised that he needed to sort of go, and yeah, he sort of pushed through and found a deal, and he ended up taking. Actually, I think the final number was sort of like 1 times or 1.1 time revenue, or no, sorry, it was at 1.1 times profit.
Mhm.
Um, and that was a big shock, but that was what he needed, and he got that, and that was fine. And I think that for him, you know, that that was just a shame. And I looked at that and thought, do you know what? He's fine. He lives an all right life now. But I'm sure there will be people who look at that and they would have been relying on £1 million exit to fund their retirement. I'm sure there will be people like that. And I went out and I looked at the market, and I spoke to a few business owners, and I found that actually that is the case. There are lots of people who are relying on the exit of their business to fund their retirement. And, in some cases that's going to be fine. And in loads of cases, they're going to be really badly let down. And I think that's a massive shame. And so I thought, okay, there could be something here. Maybe I should go out into that market and sort of try my hand, so
Go
to
on, what
speak.
happened then, man? How when you say trying your hand, what were the first, the testing stages? How did this all kick
How
off?
did it kick off? Actually, with a bit of luck. You know what? I was just speaking to as many sort of. I'd do it completely differently now, by the way. But back then, I was just speaking to business owners and speaking to people and saying, "Yeah, look, I'm trying to set up an accountancy practice." Actually, then it wasn't meant to be an accountancy practice. It was going to be a finance function, because I thought the problem is that most accountants, if you think about it, they work they don't really know in the SME. In big accountants, they represent the company or they represent an individual. They don't represent both. And I think what I found in the smaller world is they don't really know who they represent.
Mhm.
Yeah. And so by but what ends up happening is one gets neglected. So and it varies between firms, but they sort of decide, oh, we represent the company or we represent the person, and very rarely do you find an accountancy practice that actually has a holistic overall
Mhm.
view. And so my initial thing was, okay, we're going to represent the company and we're going to come in from like an internal consultant point of view. We're going to help them build out a finance function, because a finance function will be one of sort of the key assets that will, reduce a lot of the risks throughout the business in terms of, from an acquirer's point of view. We'll help them build out that function, and then we can support them through the exit process. And for a number of reasons, we struggled with that model and ended up evolving into an accountancy, a full-on accountancy firm. And I think it's just about how I was selling it, and I was, young. I still am young and naive, and got loads to learn.
Me too,
Um,
mate. Yeah.
yeah, and so we're all on this journey really, and I've now the same, right? Running a business and learning as we go, and so we evolved into an accountancy firm. We try and be as holistic as possible, and make sure that we can take a step back. And now actually the way we do it is we say, okay, well, what are you trying to achieve as a business owner? Okay, well, let's zoom out. How can we help your business get you there? And I think for some people, it's just about knowing what journey they're taking their business on.
Mhm.
You know, Daniel Priestley talks about this all the time, right?
I love his stuff. Yeah.
Yeah, he's
Yeah.
fantastic. And for loads, his whole thing is about, you know, you've got a lifestyle business and then you've got like a scalable business, you know, and those are two very different business types, and they require two very different types of business strategy. And I looked at that model when I first read it, and it's 24 Assets, fantastic book, and I thought, do you know what, that is incredible, but actually it's the same when it comes to exit. There are two very different types of exit journeys that you want to be going on, and it's going to depend on whether you're running a lifestyle business or whether you're running a scalable business that you're going to sell out for, you know, multi-million, pounds probably, or dollars, with a really high multiple. And those two things are really different.
Because like a lifestyle business is just for people that don't watch or read Daniel Priestley. Can you just explain the difference to people between a scalable business and a lifestyle business?
Yes, I think at the fundamental is that a lifestyle business is built to provide a good income and and a flexible lifestyle for the owner. You can have really successful lifestyle businesses. So people think it's a numbers thing. It's not. I've seen lifestyle businesses with £2 million worth of EBITDA. Um, and, you know, I've seen scalable businesses with, you know, that are loss making. So, but the lifestyle business at its core is a business that's built to give the business owner good income today and a good flexibility and a nice lifestyle. And I think actually, um, it's most businesses are lifestyle businesses. Most people will set up a business for that purpose.
Mhm.
A scalable business is a business that is set up for exit. Actually, it's set up to sort of be, you know, the next multi-million-pound company. We want to go. We want to sort of dominate the space in this area. You know, it's really sort of we're going to build our assets over the next few years, and we are going to make them the sort of the best assets that we can, and we're going to have this business that is the income or the return on building that business is all going to be wrapped up in the value of the business.
Mhm.
And you know, when I think about the best scalable businesses, you're thinking about your Teslas and, you know, your Apples and whatever, and those businesses are so inherently valuable. You know, the income for their owners often comes in the form of, you know, selling shares rather than the dividends that they might be paying. And I think it's a huge distinction. But if you look at it, those owners are always 100% focused on, we need to make this bigger, we need to make this better, we need to make it, you know, well known. You know, if you've ever read Shoe Dog, like the story of,
Loved it.
yeah,
Yeah, loved it. Yeah, great book.
right, the story of like the Nike, what they did and how they built it. You can see even when they were small, they were thinking big,
Yeah.
right? They wanted to sort of take over the world and sort of be the next big thing. And I think that actually therein is sort of the trap for business owners, because I think that most business owners start out to be you know, I want time, I want flexibility, and I want good income. And what ends up happening is somewhere along the journey of their success, they sort of forget why they started out and started just sort of, oh well, you know, we're growing, we're doing really well, so I should pull in all the systems. But they don't really know what type of systems they're putting in and what type of assets they're building. Um, and yeah, so I think that is the first thing that we always say to people is, well, what are you in this for? Why are you doing this?
You know, when you talk about assets, what do you mean?
Um, so it's a good question actually, because there isn't an easy way to put that other than the accounting definition, which is anything that will allow your business to generate more money, right? So, um, and the reason why I don't think it's easy is because there are very easy assets, right? You know, a house or a property is an asset because it will generate you rental income.
Mhm.
But in today's world, um, assets are becoming a lot less tangible, right? You
Absolutely.
can't really feel them anymore. And it used to be that something like, oh well, intangible assets are like your processes and your systems. But as the world becomes more and more sort of AI focused, and we start valuing people and the interaction between people, actually a culture of your business, the culture of your business is an asset.
I read that, or I listened to it somewhere. You said it's like one of the things that can actually really jump that multiple up. It's like you've read my questions because we're going to come. How? So let's talk about culture as an asset because that surprised me when I. Like,
Okay. Well, look, I mean, I think when you think about it, so I'll bring it back a second. I'll come back to it, back to culture. If you think about when you're selling a business, what you're really selling is a portfolio of assets that come together under this thing called a business that generates income using the business model that you have, right? Um, and so it might have lots of different pieces of assets. And if we think about it as like sort of a fashion brand, right? So the fashion brand will have the brand, that's an asset, and then it's going to have, it might have a particular fabric that it uses, and so it's got a little bit of IP around the fabric. It's particularly breathable or whatever, and there's some IP on there that, well, no, that's a different asset. And then it's going to have the management style of that business, because the business has grown and has a particular way of working, and it's got a particular set of values. And
mhm,
well, that's an asset, actually, the way in which it works, and its way of working. um and then it might have, the way it puts it together, its distribution channels. Well, those are going to be assets. Its customer bases. Its customer base is definitely an asset. And you see, you bring all of those together, and they're all in a successful business. They're all worth more together than they are individually,
mhm.
right? And when you don't, you have this thing called an asset purchase, and that's what that basically is telling you, is that actually one of those things individually is worth more than the rest of the business, right?
Mhm.
You've got a really good customer base, but we don't think that you're monetizing it well enough. So actually, we want you to. We're just going to buy your customer base. We're just going to buy the asset that is your customer base, and that's what it is. And so, the reason why culture is so powerful is because in most businesses, what you're actually buying is the team, right? If you think about it, particularly, it's even more the case in smaller businesses. In larger businesses, there are other assets. The brand becomes much more of a strong asset. And if you think about it, like now in today's world, Nike, if the team was terrible, they would probably have at least 10 to 15 years of run rate without that, where they can leverage the power of the brand, right? But in an SME business, if I think about an accountancy firm, if the team is terrible in an accountancy firm, you've maybe got 6 months before your clients are flying out the door,
Mhm.
right? And so in a small business, the value of what I'm buying, when I'm buying a business, most of the value is wrapped up in the culture and the team that you've built.
I mean, is that not risky though? Because like, I'm just speaking out loud. If their company's getting bought, like the team could leave, couldn't they? They'd be like, "Oh bloody hell, this new guy's come in and blah 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 blah." And
We
is that? Do you see that as a risk?
Yeah, absolutely. And that's one of the reasons why SME SME small businesses are inherently more risky. And that's why the valuations aren't the same as what you see in large businesses, right? Because, you know, there's always an inverse relationship between valuation and risk. Um, and it, sorry, and if you think about it, that's everywhere, right? If I'm going to take more risk, I want more reward. Um, and yeah, you're absolutely right. One of the biggest risks in the small business is what happens. Like, how do I know the team aren't going to walk? What do we? How do we know they're happy? How do we know that there is a culture fit? And those things often you can't. That it's really hard to do due diligence on those things,
Mhm.
you know. And that we often when we're working with buyers, that's one of the things that we're often talking to them about is, these are things that you need to be doing. You need to get a feel for that business. You need to be in there as often as you can. Do you have an identity fit with the business, with the owner? There's a really good sell side consultant that we work with. We don't work with many brokers, but
Because they've got a bad name, brokers, haven't they?
yeah, for good
Oh,
reason.
yeah.
Yeah.
Come on, let's share a few of them.
Well, I just think that generally brokers they'll take a large amount of money up front
Mhm.
to put together an information memorandum, which is essentially not worth the paper it's written on, but it's cost you a fortune. They'll promise you the world and do very little to send your business, and actually they're making it harder for you to actually sell your business because they're giving you false expectations and just telling you what you want to hear.
Mm.
That's the worst case. They've taken a nice number up front, given you false expectations, made it way less likely to sell your business. Um, and so the people that we work with generally are people who, they'll give you sensible expectations. I'm not saying that, of price it based on the floor or whatever. Like, obviously anyone can sell your business for nothing, but giving you a realistic expectation of what the business is worth, maybe even telling you a little bit about, oh, well, if you were to do X, Y, and Z, that would significantly improve.
I mean that's a good thing, like day one in the data room sort of thing.
Yeah.
What are the first things that you look at?
Well, for me, it's always about the P&Ls and the financials. And actually, one of the things that I'm always interested on is not the deliverables themselves, but how fast it takes to get when we're asking for management accounts, how quickly do we get them?
Mhm.
Um, and I know that because I know that when we're um, when we're selling a business, if we're not delivering the management accounts straight away, it's because we have to prepare them on behalf of the business, right?
Wow. So then they've not
So,
even got
so
them ready.
they don't have management accounts ready, or because we're holding it back because we don't necessarily think it's right to produce them now, and we understand the situation, so we're playing
Why
the.
would you not give them somebody? What would be a reason not to produce them?
There's a few reasons. If that quarter was particularly bad, but the next quarter's good, so it's worth your while to delay it so that
Yeah.
you can produce both quarters together and say, look, that quarter wasn't so good, but here's the next
Okay,
quarter.
I
It's
get
great.
it. Yeah.
Yeah. Why else would you hold it back? If we're waiting to make a decision internally, so it's really good for you to blame the accountant for delaying things because accountants have a really terrible reputation, accountants and lawyers. So even if we do, I always say, well, just blame it on us because it's much better for them to blame it on us than for them to say, oh yeah, internally we haven't got our crap together. Um, so yeah, I think there are a few. I think coming back to what I was saying before, actually, merger and acquisitions is more about managing the relationship between two parties than it is about the people. The broker that I was mentioning, the sell side consultant, he always says, it's 80% heart and 20% head. Um, and sometimes I really feel that more than being an accountant, I'm a therapist. Um,
I really identify that with that
yeah, I
working in
bet you do.
insolvency.
Yeah,
Yeah.
I bet you do. Yeah. And I just, yeah, I think that's what it is. It's because most of the, business ultimately is about people. And I think that we are operating in the sort of space where people are interacting with, the end of a process or, the, in my case, it's about legacy and the handover between two people. And in many ways, it's like, the coming together of these two parties that have never met before.
Mhm.
And, there is a lot of emotional attachment.
I get it. And do you know what? I sort of think that what we found is it's a really easy way to stand out from almost all your competition.
Mm,
I've been in meetings with other firms and they're spouting the Insolvency Act at a director is petrified.
right.
And I'm like, just fucking listen. What he needs to know is what is the problem and what you're saying, what does it actually mean to him?
Yeah.
And actually sometimes slowing it down, going, Are you all right here? You know, do you want a minute? You know, do you want to talk when, because it's, I think for both sides, whether obviously I deal with company closure. I mean, we get a lot of inquiries potentially where they're looking to buy a business. They've looked under the hood and they've realized there's a ton of redundancy that they'll take on, big dilapidations on, and actually they don't want the business, like you've said before, they just want the assets.
Yeah.
So what they do is they want to put the business either through a liquidation or an administration, get rid of a lot of the debt and actually take it and start again.
Mm.
But it's about, it's never lost on me what's happening to that person who's having to put their business through, because they're not getting any benefit from it. They're perhaps getting rid of a headache. It's the other person, the other side, that's going to get any upside.
Yeah. And it's tough. It is tough actually. And I think I've seen quite a few obviously in my time, and people sort of bounce back, and often people do bounce back, but I think that it, they often have to work through a lot of personal stuff.
Yeah.
That feeling of being a failure, and not making it and not matching the expectations of what they wanted to do, and the guilt of the people they've let down. No one likes to. I think everyone likes to paint business owners as oh, they're only in it for themselves and whatever. I think actually most of them they feel like their payroll is a big responsibility for them.
A lot of them, listen, some of the directors I speak to, when I look at what they're taking, I'm like, why do you want to do this again? You would be better off. You'd be better paid in McDonald's.
Yeah.
I mean, we've talked about the scalable businesses. Really interesting. Is a lifestyle business sellable?
Um, it can be. I think that again, you have to think about it from a what are we selling when we're selling a lifestyle business, and I think that for me, in terms of helping someone who runs a lifestyle business to exit, it's about thinking, okay, well, what are we trying to achieve? You need comfort in your life today, but you also need comfort in your life post exit. And so lifestyle businesses will be more risky to an acquirer, and it's about explaining that to a business owner, telling them what their current valuation is, giving them a little bit of that shock, and saying, okay, that's fine, but for you, what you're doing now is, instead of investing your profits in back into the business, you want to be investing those profits into yourself personally and your personal assets. Generally, okay, there might be a little bit of investment into the business, new system, maybe a new person, a little bit of natural growth. That's fine. But generally, what you're going to be doing is you're going to be taking that money, investing in personal assets, looking after yourself personally, so that you can be more flexible over the term of your deal. Because generally, if you can be more flexible on the terms, you will get a better valuation. And if you need the money today, if you need more money up front, you're going to be you're going to be sort of in a bit of a corner when it comes to the valuation.
What a type of hypothetical flexibility that a seller needs to show. So obviously the ideal is multi-million pounds on day one and I'm off to the beach.
Yeah.
That's quite unrealistic for most people. What would be the type of things that they would need to consider?
I think in most SME businesses, there is a large element of deferred. And I think that the amount of deferred that we see on our clients, it really ranges. So I've seen everything from, sort of 10-20% deferred, all the way down to, 100% deferred. Um, and and I think it really depends on the flexibility of the owner, as I was mentioning before, how much the owner wants the valuation that they've got in their head, and what they want the money for, and etc. etc. I think that what is really important for business owners to know is that generally people in the SME space do not have money, right? They're not people you're not going to find someone who's got £1 million in their back pocket and saying, I know what I want to do. I want to buy your really risky business for £1 million. It's not generally what happens, because if you've got £1 million in your back pocket, you're probably going to invest it in more stable, safer investments. They're going to get you a stable, anywhere between sort of 15-20%, depending on the type of investments they want. If they wanted more stability, yeah, they can reduce the risk. But why would I take a business? Why would I buy a business and put all of my money into that? And in fact, even people who do have that money, they understand the system and they will never invest all of their money up front.
Mhm.
And so what most people buying SME businesses will do will be they're going to take out an amount of debt, and they might use assets within the business to fund the acquisition, and they might use you to fund the acquisition. And what we tell our business owners is, actually, if you find the right buyer who's going to take your business and you believe that they're going to make it a success, it's not really about where the money's coming from. If you get what you want from the deal and the business is going to be successful beyond, that's everything you could ask for. And as long as you're looked after, that's a good thing. You don't need to get, I think some people get a little bit emotionally, like, sort of, they've painted the picture of what their business acquisition looks like, and they sort of think it's going to be this person who's going to come in with X amount of money, or, oh well, you need to have X amount of skin in the game. But it's just not always that simple. And it's not always running. It's not easy for them to run a business if they've completely leveraged the deal, and they're not going to get paid themselves for maybe a year or two. That's also quite difficult. It puts a heavy cash flow challenge on the business. So as long as what they're putting across on the table is reasonable, and you believe that the business can cash flow what they're choosing to do, I think, actually, the more flexible you can be, the better it is.
What are the top reasons you would see a buyer go cold? Like top 3 reasons that they start to ghost the seller.
Other than unrealistic expectations, by far and away the biggest one that a buyer will pull out is unrealistic expectations from the seller, right? If there's unrealistic expectations, the seller's just very hard on what they've been told by their mates down the
I
pub.
mean, that's it. You hear of 5 times multiple, 10 times multiple, like multiple of revenue, multiple of profit. Where would, I mean, I know it's hard to say without any more context, but what would a service business look for to sell for?
A service business.
Yeah.
Um, it depends on the quality of their client base, but it can be anywhere. It Actually, the biggest thing for me in terms of multiples is probably the revenue of the business, because the biggest indicator of how risky your business is how large your revenue is and how large your EBITDA is. So,
And for those that don't know, what is EBITDA? Let's explain.
so in simple terms, it's the cash earnings of your business. So it strips out all the sort of accounting, the funny accounting that can happen. So, your interest, your taxation, but more importantly, your depreciation, and amortization, which are sort of the judgmental accounting entries. And it's really good for looking at, it's a very simple metric to see what is the cash generating ability of this business if I kept everything really simple, and how can I compare that against other similar businesses. So that's why EBITDA is used as a multiple. You shouldn't rely on it too heavily, and there are other things that we look at, but the reason why EBITDA is used in valuations is because it's really good for comparison between other businesses. It strips away all the judgmental areas of the business. And yeah, so I always tell businesses, just think about it as the cash generating power of your business, right? So EBITDA, yeah, so I think the higher your EBITDA is, generally, the better your multiples are going to be, because if you're generating, quite simply, if you're a £10 million business and you're generating £3 million worth of EBITDA,
So is that £3 million of profit?
yes, for now, yeah,
To
3
keep it
million,
really
to
simple,
keep
yeah.
it simple, £3 million profit.
Uh-huh.
Yeah. You are less risky than a business who is, generating maybe £3 million in revenue and £1 million in profit.
Why? What's the difference? What does a buyer see that's so different in that?
Well,
Because in real terms, the business that's doing 3 million and generating a million has got actually a bigger percentage of profit than the 10 million that's doing 2 million, £10 million turnover that's doing 2 million. That's how my brain, as a layman here.
Yeah, so I think the reason why is because at that £10 million mark, if they were to lose one client or two clients or even 50 clients, if they were to lose £1 million worth of revenue tomorrow, it wouldn't affect the business all that much. Whereas if you're a £3 million business and you lose £1 million worth of revenue tomorrow, that's your whole profit wiped out.
I understand.
And that is the concern. It's what happens in the day post acquisition. Again, a £10 million business will probably have maybe 5-star employees. So if you lose one or two of them, you can survive. A £3 million business, if it's lucky, will have like 3, but maybe we'll have 1. And if that person walks, the business goes. And so that's much harder to keep them tied in. And that's why a larger business will attract a higher multiple because the risk is inherently less. And so if we're thinking about a consulting business, it's really going to depend on, what do your contracts look like with your clients? How big is your revenue? How big is your profits? And what are they buying? So I know, for example, in the accountancy world, up until about £500,000 in EBITDA, that the asset that an acquirer is looking to buy isn't your profit multiple at all. It's your client bank, and they will pay you a multiple of revenue because all they're buying is the client bank. So maybe it'd be
on that bottom line.
exactly. So maybe they'll pay you 1.2 times revenue. But as soon as you get to sort of £500,000 in profit or above, then suddenly the multiple flips on its head, and it can be anywhere from like sort of 6, 7, 8 times sort of return on profit.
Okay.
Yeah.
Very interesting. And what other things are like really put off a buyer?
So I think, so a toxic culture, but really bad, sort of team members in there, the big team issues, whatever. That's a big sort of red flag. I think a breakdown in trust. I think trust is the number one thing that is.
And that's got to be two ways, hasn't it? Because are sellers quite skeptical and frightened of the big businessman coming in and ripping their eyeballs out?
Yeah, absolutely. They don't want to be scammed out of.
Because everyone wants a deal, don't they? Both sides want to.
I think, yeah, exactly. And my thing is always, I always try and tell people as much as possible, what you want is the fairest deal for everyone, right?
Yeah.
You don't want to screw anyone over because you're going to have a relationship together for at least 2 years,
Because you're going to be kept on.
You might be kept on a little bit. You might have a consultancy role between them. You might have some deferred payments to be made. You want that relationship to be good. And if nothing else, most business owners feel an obligation, as I mentioned before, they feel an obligation to their team, the people who helped build the business, and you want them to be looked after as well. So it is really important that you've got sort of that two-way trust between you. And actually, most business deals that fall apart will fall apart either because cash flow can't get the cash flow to work, or there's been a breakdown in trust between buyer and seller. And if you think about everything else, all the financial things that can go wrong, if there is enough trust between buyer and seller, and there is enough of a values alignment, and that we both think that this deal will work, and I get on with you, and you want the deal to happen, I want the deal to happen, everything else can be negotiated. Any financial issue, I've seen it where an acquisition has gone through even after the business has lost its main client because everyone wanted the deal to happen. And they were really open. Everyone was really open about what was going on, and it wasn't hidden. There was nothing. No one felt like you're trying to pull the rug from under my feet. We're looking at this as like we're on the same side here. We want this to happen, and I think there's a lot of vulnerability to get to that point. And so I always tell people, you need to build that rapport. You need to build that sort of trust between you.
I don't know if I read it somewhere that you posted, I heard you said, but that there was a statement like ready to talk versus ready to exit. What are the differences?
Um, I think when someone's ready to exit, they know. It's like, I've taken the business as far as I can. I'm out. I think before that, people are, they say they're ready to take a break and whatever, but they're not. They're not sort of burnt out by the business. They're happy to have an open conversation about it. And if the numbers are right, I might take it. Sort of like my dad at the beginning of
Would you
his
call them a
journey.
tire kicker? That's
Maybe,
probably
yeah,
my terminology.
yeah,
You know,
maybe, yeah,
yeah.
maybe that is what it. Yeah, yeah, maybe they are. The reason why I'm saying I think they're is a little bit more serious than that, because I think that they are testing the market with an eye of understand. They want to make the sale. I think they generally, people, when they're having a conversation, they know that the acquisition is going to happen at some point. The
Mhm,
sale will happen, but I don't think they're ready for it today.
mhm.
Yeah, absolutely.
One of the things I wanted to talk to you about, like you hear these stories where like a business was worth X million on paper, but now it becomes worth much more after you've gone in there because of some fixes you've suggested to them.
Yeah.
Could you run us through a few examples where you've come in, you've gone, right, you've got this business and it's worth, I don't know, but if you do this, this, and the other, we can get it there.
Yeah, I mean, look, there's quite a few. Actually, one of my favorites is a few years ago we had a client come in with nice business, maybe making 1.7 sort of revenue, and around 300 to 400 in profit. So a really good business, doing really well. They had an offer on the table for 1.2. Um, and they came into us saying, like, we've got an offer on the table for 1.2, but they're asking us for a whole load of financial information. It's just been COVID, we had our bank account closed, all of this sort of fun stuff, complete mess. Um, and can you help us just put the accounts together so we can get the deal closed? And we did, but the thing is that in the time the information was being taken, no one was having those conversations with the buyer. Um, and so we produced a set of accounts. We sort of kept saying to them, look, you need a bookkeeper, you need someone to sort of sit behind this and manage it, you need a little bit of control in the business. And they were like, yeah, but we just want to get the sale done. Sale fell through. Um, and we worked with them over the next sort of 18 months. And we sort of said to them, okay, right, let's do this properly. Let's keep you prepped, make sure you've got management accounts. They didn't really want to be in the business. They're completely burnt out. So all we did was put management accounts in and prep the accounts. Um, they did do another couple of changes just in terms of how they sold, how they were selling. They took the business up to 2.1 in revenue and 500,000 in profit. And we got the business sold for 2.4, which was pretty much double, yeah, what the original deal was done. And it went through. And that was literally just about the idea of having, well controlled accounting function. Um, there are other things, but I think for you, the most important thing is always to know, for a business owner, is where are if I was to make an investment in my business, if I was an investor, what would I be looking? How would I look at how would I view my business? And what do I think are the most important assets in that business? Is it the client base? Is it our way of marketing? Is it our brand? Is it me? Um,
I
uh,
mean, that's a problem for a lot of businesses is the founder led. Listen, I'm the face of our business. We have, a large team behind me, but I was talking before that, I've been doing videos on social media for years talking about insolvency and it's worked really well. But I'm the brand. So
mm.
surely that is a problem.
Yeah, it is absolutely, and that is. I think that's the case for most business owners, exactly as you say, because it's not just about the fact that you're the brand, right? Because I think that um, Richard Branson is the brand of Virgin,
Yeah.
right? Um, it's not just about that. It's about the fact that there is a entrepreneurs have a special sparkle. They've got like a magic dust, right? They've got like an attraction about them. There's something special about them that forces them into being an entrepreneur and then being a successful entrepreneur. And when you think about how many people actually make that, it's not a big number
Hmm.
that get to, you know, run a business for 10, 20 years, particularly once your revenue over £1 million. Um, I think people often they've got this bias in their head that most businesses are sort of like, oh, over 100 million, but it's not the case. Most businesses actually don't succeed,
Yeah,
as you
I
know,
get it.
right? And so if you've run a successful business and got it over a certain level, you are the 0.5%. You are sort of the maybe the 0.1%,
Hmm.
Y- you you are a rare breed. And I think that the step one in selling your business is accepting that. And the fact that you are the 0.1% is going to be incredibly hard to replace you at all. Never mind trying to. I think what a lot of people do is they try and replace themselves with one person, and it just never works. Normally, you need three or four really good people to replace an entrepreneur.
Mm.
Um, and when they come in, they will be way better than what the entrepreneur will do on their own because they do their niche area much better than the entrepreneur could. Because entrepreneurs, they often wear lots of different hats at any one
Mm.
time. I'm sure you're exactly the same. One day you're marketing, the next day you're helping an insolvency. But I think that's what it is. And then you can sort of separate. Once you do that, you're in a position where you can start separating and thinking, well, what are the assets that someone would be buying if they were to buy my business? And therefore, how can I get a valuation on this? And how can I, you know, make up for the fact that, as you say, all the marketing comes through you right now?
It's I mean the book that the Daniel Priestley book, The 24 Assets. I've read that myself, and it sort of forced me to take things like intellectual property seriously. Like you just it's stuff you don't know what you don't know, do you? And it's like when you start to go down this rabbit hole that there's so many different things you can consider, and I suppose that leads me on to another question. If you're a director, founder, and you're looking to potentially build a business to sell,
Mm.
what are the things that you need to be thinking about on day one to actually, what are the steps to put in place to help you achieve that sale?
Um, yeah. So what we do with clients when they come in is we do sort of a soft audit with them. So we do like a due diligence. This is what an investor is going to see. And I think for most business owners, that's the first time they've looked at their business as an investor would.
I bet that's uncomfortable.
Yeah, it is. Um, and I think that's a really important thing is to start thinking of your business as an investor. Um, if you've got time, we always try and get people to make an acquisition because
Really?
going through the process is fantastic.
Okay.
No better way to learn the process than to actually do it. And also, if it's done cleverly, like I just had a conversation with a client before I came out here, and they're looking to buy a supplier of theirs with a really good reputation in the industry. If that deal goes through, that it would not just transform the business in terms of revenue, it would transform the business in terms of reputation and profit margins and everything. It would open up a lot of doors. And so a smart acquisition can be fantastic for a business, really accelerate growth, but also really accelerate the valuation and put you in the seat of an investor. So if you've got time for it, maybe you're thinking you've got 5 or 7 years horizon, then and you're open to that. Some people just don't want to do it, but you're open to that. That can be a really cool thing to do. Um, but if you're just looking at your business and thinking, well, what can we do to make this as good as possible? For me, it's actually about what contracts have you got? Are your contracts tight, airtight? Are your contracts sensible? How are your financial reports? How do they look? do you get regular financial reporting? Um, See, people think that regular financial reporting is just about getting the numbers on time and ticking a box. But actually, it tells me something about the way you run your business, right? Because there's a really big difference between running the business based off of, my gut feel and the bank
Yeah.
balance, and running it off of, really detailed financial reports that we get in a really timely manner. And we sit down and we have, you know, a board meeting with all the managers in the team. Well, that doesn't just tell me about the finances and the business anymore. That tells me about how you run the business and how you've taught the managers in your business to run your business. So that's going to be really cool. Um, and then it's about, processes and controls. I think those are sort of the sort of key things. But then really, if and that I can give you just sort of like this, but actually, if you think about it, when we do that due diligence, it's about what we do really. What we're trying to do is ascertain what are the assets in your business, and how strong are those assets, and how are you presenting them to a third party? Because if you can present those assets as more valuable, you're going to get a higher valuation.
So one of the questions I wanted to ask you is, going from a top four firm, PwC, to doing what you're doing now, what have been the biggest changes and challenges for you personally?
um, I think when I first started out, actually, it's really interesting. When I first started out, I tried to sort of mimic what I'd learned in the PwC. And I think, as with a lot of people who've been through the Big Four, I took a lot of things for granted. And I think now I look at the way that we were sort of trained and developed and whatever, and I see it, and I see sort of the effect of culture in a firm, and how, they had, when I was, certainly when I was there, it was a fantastic culture. You just sort of became a PwC professional. That was what they called it. And everyone in the firm wrote a certain way, they acted a certain way, they upheld values, and they didn't need to talk about values. In fact, I can't remember what the values were, but I can tell you what it looked like.
Hmm.
Yeah, um, and it's actually a really clever way of just developing these people who, all of us, we were all sort of raw out of uni, or raw coming in from another accountancy firm, and everyone without fail became what they wanted you to be, right? And it's an incredible thing to see, because it was almost like a factory of churning out accountants. And I remember asking, how do you be successful at PwC, when I was sort of a junior in the firm, sort of asking one of the partners, well, what's going to dictate, how do I be a good accountant? And they sort of said to me, no, don't worry about being a good accountant. You will be a good accountant because you're here, and that will just happen. What will dictate your success is how good you are at selling and blah blah blah. And
It's amazing to hear that,
yeah,
yeah.
yeah.
Because accountants and selling is like we don't talk about that.
No, no, it was all for them. It was all about the network. And actually, it's just really clever, because their whole business model was, we're going to train as many people as we can, because we know that these people are, if they're not going to be the partners of the firm in the next generation, they're going to be the CFOs or the CEOs at our clients.
Yeah.
Yeah. Um, and for me, I took a lot of that for granted when I started out, and I took a lot of what they'd built for granted, and I just sort of assumed that I could replicate it in my own way, without, you know, thinking about how conscious they were at building that. Because for us, it was it it's the, there's that sort of cycle of, you go through conscious competence, and then you
Yeah,
get to
4 steps of
yeah,
learning, yeah.
and then you get to unconscious competence. And I was in this environment where it was just unconsciously competent at everything it did. And I took that and just sort of took it for granted, and thought that when I left and came out of that ecosystem, it would just carry on being competent. And so when I hired, I made loads of mistakes, and
Me too,
as
mate.
yeah, as we all do, yeah. And yeah, didn't sort of think about what those processes were. But I think for me, actually, now it's trying to be consciously competent, and put those processes in and get that in, and explain that to my clients as well, because that's where the differences will come.
So you've been such an interesting guest. Like, I've
Thank you very much.
really, really enjoyed speaking to you. For those people who are watching and listening on the various platforms, where can we find out more about you?
Well, I always say that my LinkedIn is probably the best place. I'm always posting on there, loads of little sort of little tidbits and bits and pieces. Um, and yeah, I think absolutely my LinkedIn. I've also got a particular sort of offer that I sometimes promote. So if
Come
that's
on, promote,
yeah.
promote, promote,
Okay.
yeah.
Yeah. Yeah. So what I do for whoever sort of heard me on a podcast, I do a free valuation for them if they are interested. I'll do a free valuation call, and I will in that call go through sort of the three things for your business that would move the needle and increase your valuation. So we don't do can't do an infinite amount of them. I sort of limit it to sort of 6 a month. But we offer it to anyone who sort of heard me on a podcast as a
Well, we're
conversation.
going to reach out to you like for some show notes, contact details, email addresses, anything else that you think people will benefit, and they're going to be in the description below.
Brilliant.
But honestly, mate, it's been an absolute pleasure spending some time with you.
No, I've really enjoyed it. Thank you
Thanks
very
a lot,
much.
top man.
Thank you.